Welcome to Her Fabulous Financial Future, a podcast by Women's Wealth. Here at Women's Wealth, we want to be your best financial friend, your BFF on money matters. If you've ever thought, I'm useless for money, or it feels like I should know more about this stuff, but somehow I just don't, then this is for you. I'm Sam Seckham, an award-winning chartered financial planner with decades of experience as an independent financial advisor. But much more relevant and interesting are the amazing women I meet and their stories. Let's talk about finances, bust through the taboos and take charge. We can create our own fabulous financial futures. Hello everybody. It's the 8th of August 2022 and this is Women's Wealth, #SavvySam, talking to a couple of awesome lady mortgage advisors about what has turned out to be a bit of a shocking week for us in terms of the news about interest rates. The Bank of England have voted to increase interest rates by 0.5%, the biggest increase for 25 years. It's all been a bit of a shock to the system. And the mortgage providers have not been slow to change the rates that are on offer for mortgage people who are taking out mortgages, people who have mortgages. Everything's on the move, combined with cost of living increases and that warning from the bank, which I think took everybody by surprise, around us slipping into recession as a country come the end of this year. So it's all looking like it's mounting up to be a very tough winter. And I was surprised how frightened some of our clients were by all of this news mounting up. And they've come to us with some questions. And as I'm not a mortgage advisor, I'm an independent financial advisor and a chartered financial planner, not that kind of hot on the mortgage market. So I thought I'd better get us some superpower in to talk us through this. So I'm very pleased to have on the call with me today Funmi and Dawn. Both of them are ladies who currently advise on this stuff and know the market far better than I do. Ladies, thank you for joining me. Funmi, did you want to give us just a bit of an intro to you? And then Dawn can have a little bit of an intro to her. And then I'm going to introduce you to one of the questions my clients have been asking me and get some help from you. So Funmi, tell us about yourself.
Sure. Thank you, first of all, for inviting me on to speak about this. I'm Funmi. I currently am a financial coach and educator, but I'm also CMAP qualified. That means I've got the qualification to advise on mortgages. And from September, we'll be starting to do that. I'm really interested in financial education and financial products and helping people to understand their money and manage their money better. There are lots of people that are talking about mortgages at the moment for the reasons that Sam has just described. So yeah, I'm really looking forward to today's session to hopefully help people understand what steps that they can take to kind of help themselves for their future.
Thank you very much. Dawn, tell us about you.
Hello, thank you for having me here as well. So I'm also an independent financial advisor, but I do also do mortgages. I've got around 15 years experience. So I was around in the first recession of the mortgage market back in 2006. So we might have a good idea of what we're in for. But as Funmi said, really looking forward to helping people make some good decisions now that they'll thank themselves for further down the line should things go the way that we are anticipating.
Fabulous. Ladies, so grateful to you for joining us. One of my clients asked me the other day whether she should actually take the hit of a penalty by cashing in or coming out of her fixed rate mortgage product early, rebroking it at the current fixed rates that are available so that she knew what her mortgage was going to cost her and it wouldn't then keep going up over the next couple of years. Now, the penalty looked quite sizable to me. So she was talking about taking a £2,600 penalty hit to get out of her current mortgage, and she currently had a mortgage of around about 150,000 with 6 months to run on the product. So I was sort of a bit stunned. I thought, actually, that's a lot of money to pay to get out 6 months early. But then I also thought actually interest rates are likely to have gone up again quite considerably in that 6 months. So is it a good idea or not to do this? I mean, what do you think?
What a question. Well, I'd start off by saying that I don't think that this person is alone in having to think about this being a potential option. I think there are a lot of people that are in a similar situation at the moment. Is it a good idea or not? I think it's going to be very individual and specific to each person. What I would start off by saying, though, is I think you mentioned that they had 6 months left to run on their current fix. Now, for lots of lenders, it is possible to reserve a rate up to 6 months in advance. So instead of I guess she's kind of got two options or two things that she could potentially do in this scenario. The first thing would be to, as you said, maybe pay that early repayment charge of £2,600 to lock in that 2-year fix. And that would kind of come into place fairly swiftly. Obviously, she'd then have to pay the arrangement fee as well. And she'd need to look at the numbers and see. So that is definitely an option. But it seems, on the numbers alone, it feels like that's perhaps quite a costly way to do it. The other option would be to try and arrange that new rate to kick in at the end of the expiry of the next 6 months of her current deal. So if she were to do that, then she wouldn't end up paying the £2,600 early repayment charge, but she'd also have the certainty that in 6 months' time she'd be on a 2-year fixed rate for the next 2 years. So those are the two options I've been looking at. And on the face of it, on the numbers alone, if she's comfortable and the next 6 months' payments at her current rate are affordable, it might be that the other option is better because it saves her effectively £2,600.
That's not a small amount of money, is it? £2,600.
It's a lot. It's a significant amount of money. Yeah.
Dawn, what struck you about that case?
Yeah, I mean, it's quite a broad question that we ask in the first place. Is it worth it? Because obviously we have no way of knowing what the rates will be in 6 months' time. But as Funmi quite rightly said, for a lot of lenders, whether she's moving to a new lender or sticking with her current lender, you can start looking at your rates 6 months in advance. But what a mortgage advisor would do is look at the whole picture. So what rates are available now? What is she currently paying? What might the picture look like in 6 months' time? And then we can really drill it down to pounds and pence of what the difference would be if she, whether she did or whether she didn't. £2,600, if she paid that to move out of a rate now, is she going to save any money compared to if she waits until the 6 months is up? And the answer to that is probably she's not going to recover that £2,600 in 6 months worth of payments. But we would look at the whole picture and see what other options are open to her in her overall circumstances as well anywhere, and see what the outcome could be. But yeah, Funmi pretty much hit the nail on the head there with the response.
I think it's important for me to just mention that with this particular lady, she's a client of ours and we know her circumstances. We've got a kind of much bigger picture of her finances other than just the mortgage. The mortgage is one part of a big picture. And it's interesting that she felt so anxious, wound up by the news, even though actually when we did a bit of cash flow modelling with her, and ran the worst case scenarios of serious increases in the mortgage rate, she could afford that. She wasn't, her margin isn't so narrow that she's likely to find her life unaffordable. So it was a question of it's a £2,600 definite penalty, and you can actually afford the worst case scenario. So maybe you can afford to take the risk that interest rates are going to go up and wait until you can come out, or you can reorganise your mortgage without paying a penalty. But for me, do you think that the people who are offering rates at the moment with the ability to book it for 6 months' time, do you think that's likely to change given rates are on the increase? Is that 6 months likely to be narrowed by the lenders, do you think?
I think that the amount of money that they accept onto those rates will get smaller. So what lenders tend to do is they fill a tranche. So they might say, we're offering 3.99 and you can secure it now, but once the tranche is full, they'll take it off. I don't know about anybody else, but my inbox on a daily basis is lenders saying, we've just increased our rate by this much, and it's ping, 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 ping all day. And it won't be long before they start closing products earlier. So if your client has already got in and they've got that product, then that's fine. But the amount of people that are getting on that rate might get smaller rather than, I don't know, they might do it the other way, change the time scale and say you can't do it until you're within 3 months or even 1 month. I think the other thing that's really hard at the moment is all lenders are doing different things. They're all playing by different rules, which we saw a lot through the pandemic and the rules that were happening then as well. So we might find ourselves where one client can do that and another client can't because they're with a different lender. And that's something that an advisor will have to keep kind of on the ball with and keep reading those emails that are coming into the inbox and making sure they're up to date on that information.
And I think that's another great reason why it is absolutely a good idea to use an advisor, because somebody trying to navigate this on your own with an individual lender, it's difficult. I think it's difficult for advisors because things are changing so quickly. But an advisor who can look at, a wide variety of lenders across the market and, who knows that lender A is doing this and lender B is doing something different, it's an absolute godsend, I would say. So I would definitely suggest that people speak to an advisor when they're trying to navigate all of this.
I think one of the other things that strikes me is that there are a lot of headline numbers that you can get hold of, especially on social media and things, which aren't the full story. And I know that you guys put quite a lot of effort into helping clients understand the bigger impact, the longer term impact of the decisions that they're making, and that what kind of appear to be quite small differences can add up to very significant differences over the lifetime of a mortgage. And I think there's quite a variation in the upfront fees as well, isn't there?
Used to be that when an upfront fee was payable, so an example I'll give you is I was doing some sourcing for a client earlier in the week, and we always we ask the client the question, are you prepared to pay an upfront fee if it secures you a lower rate? And with this particular lender, I did the illustrations with the 995 fee and without the fee, and there was such a very small difference in the payment, whereas before it would maybe be, depending on the size of the mortgage, it could be anything between £50 and £200 a month. As in this case, it was about £4. So then you've got to do the calculation of, is it worth paying the 995 fee to save £4 per month over 5 years? And the margins are just getting smaller and smaller. And as you were just saying, to navigate that, we have the software and the tools to be able to do that and narrow it down. But even something as simple as going back to your existing lender and sticking with them and rolling onto a new rate can cost you thousands of pounds in the grand scheme of things. Because a new lender, yes, it might be that you might say it's, a bit of a job to move to a new lender, but if it's saving you 0.5% on £100,000 per year, given the fact that everything else is rising, that's money back in your pocket that's not in the lender's pocket, isn't it?
Mm. Mm.
And I think it's really important, like you said, to kind of have somebody that you can talk to who can do those calculations. I think people are very often driven by a headline rate. Lots of people might not even look at the actual total overall cost, which would obviously need to factor in the interest rate, but also any fees that are payable. A lot of people might look at a best buy table, for example, and just go straight to the one with the lowest interest rate. And that isn't always the best deal for your particular scenario. So it's really important to kind of factor in all of the costs, like you said.
Mm. Okay. So the other thing that we're being asked is, should I fix for 2 years or 5 years? What should I expect my interest rate to be next year if I wait until my current deal ends and the new fixed rate? So where are rates going to be? When you hear that inflation is expected to go to 13%. Are interest rates going to go to 13% as well?
Terrifying thought, isn't it?
Isn't it? So what do we think interest rates are going to do?
I mean, when I first started doing this job, back in 2006, I think it was, the interest rates that were on offer with the company that I was working for at that time was 7 and 8% on a mortgage. So it's not unreasonable that we will see them come back to that level. We currently stress test our mortgages at 7%. But
can you just explain what stress test means for us, Dawn?
Yeah, sorry, of course. So what we do is we provide the illustration to the client. So your quote will say your interest rate is 2.79, for example, and then we'll do a calculation to work out how much your mortgage payment would be if interest rates were at 7% by the time you get to the end of your fixed deal, whether it's 2, 3 or 5 years. And then it helps the client to see whether or not that mortgage will still be affordable to them should the worst case scenario happen. I mean, bearing in mind, we're taking a mortgage for 25, 30, 35 years. So in that time, we're going to go through this cycle again, probably several more times. So by the time you've seen the ups and downs of those rates during that term of your mortgage, you're probably going to have hopefully come full circle back to where we are again and be on low interest rates. But that stress test just helps you to look at your long-term picture so that we've not got lots of first-time buyers thinking, great, my mortgage is £750 a month, that's okay. And then coming to the end of their deal and realising that it's going to be £1,000 a month, and then they're having to sell the property, or we're going back into 2008 when properties were getting repossessed because people couldn't afford them. But I believe the lenders use a stress test, and you'll correct me if I'm wrong, but I think it's about 11% on their illustrations that they stress test it against to make sure it's affordable.
I think it varies, doesn't it? They've just removed one of the statutory tests, basically because it was redundant and most of the lenders were using a higher bar test anyway. But I've seen all this before. I mean, the whole idea that the government starts guaranteeing the bit of mortgage between 90 and 95% for lenders to keep stimulating the market. I've seen that before as well, and that preceded negative equity for people. So I do think that, the market seems very stretched at the moment, and people are really keen to get on the property ladder, believing that prices are going to go up forever and ever and ever. And that's not what happens. Prices go up and up and up, and then they correct, and then they start going up again. And it's not the first time it's happened. It won't be the last time it happens, but it can't be far away, surely, that we're looking at a correction, because there's been lots of artificial stimulation to keep the property market going, and then we've got all this rising costs, warnings of recession. So I really don't think that you need that big a crystal ball to know where we are in the property price cycle. So I think it's really important that people stress test, don't buy a house if you think you're going to be able to flip it in the next 3 or 4 years at a profit. Buy a house because you want to live in it for 10 years and you'll be fine. Like it's that sort of thing, isn't it?
I think it's definitely a case of the times when you could buy a house, do a few things to it, flip it, and make a significant amount of money. We're not in those times at the moment. And if you're buying property to live in, you really should be thinking more long term. Now, that's not to say that the first house you buy, you have to stay in forever. But if you're thinking that, you're going to move in a couple of years' time, we don't know where we're going to be in a couple of years' time. So make sure that the mortgage that you're taking out is affordable to you now. Do your stress testing. What will it look like if in the future interest rates rise? Also, what about other costs? What will it look like if the cost of other things increases? And is that still affordable to you? Because, if you're going to be in a scenario where you don't want to be in a scenario where it's not, and we can't guarantee these things, but I think we should always look at the things that we can influence and we can control and we do know about, and use that information to make really good decisions for ourselves.
Yeah. And I think that's a great note to wind this up on, ladies. You have been so informative. Thank you very much. And I think everybody out there, here's the note of caution. But I don't think any of us believe that property isn't still a great thing to own long term, and that, you know, we live on an island where property is in short supply. So it's really hard to own property in the UK and not make money out of it over the long term. So those risks are for those people who are thinking about short-term purchase and disposal of a property. That might not work out if you buy now. And none of us actually know where the top and bottom of markets are. It's always a bit of a guessing game. So thank you very much for your help. I think the affordability thing is the key at the moment, isn't it? Make sure whatever you get into, even if your energy bills and the cost of living go up and interest rates rise, can you still afford it? Because if you can't, don't do it. Don't do that to yourselves. A little bit of patience might see you get a bargain in a year or two's time anyway. But if you can't afford what you're doing now, just don't put yourself in that position. So thank you, ladies, for your help. I think getting expert advice is vital when you're making a decision which is this big. So I'm going to put Funmi and Dawn's notes, contact details in the show notes here so that you can have a chat with them. They're both available. They both want you to make the right decisions, so they're happy to talk the options through with you. Don't make a mistake, make a great decision and create fabulous financial futures for yourself, ladies. Thank you, everybody, for joining us. This is Woman's Wealth, #SavvySam, signing off on one of our Current Issues podcasts.
Thank you for listening, and I hope you found it useful. Let us know what you thought by leaving us a review, and give us any hints or tips on subjects that you would really benefit from if we covered them in future episodes. We want to be useful. Women's Wealth are independent financial advisors, and we're authorised and regulated by the Financial Conduct Authority. But the information presented here is not intended to be personal advice for you. So what might be good for somebody else might not be right for you. If you want to talk to us about your personal needs, then feel free to jump on a free Zoom call by visiting Woman's Wealth, that's womans-wealth.co.uk.